Hello everyone. This podcast is explaining the PowerPoint slides for Chapter 8 having to do with depreciation and amortization for tax purposes. Now you learned depreciation and amortization in Accounting 101 and learned about straight line and double declining balance. The depreciation rules for tax purposes, while based on the same idea, spreading out the cost over the life of the asset, are calculated entirely based on the way the tax law says so, the IRS tables and such. So while the concept is similar, the calculations are quite different than what you learned previously. So let's get in and see what the tax law says about this. Basically, we're talking about assets that are going to last more than 1 year, and we separate our assets into real property or personal property. That's kind of the way the tax law looks at it. So, and then we have intangible properties separate as well. We also need to understand when they place the property in service. The date is important, at least to some extent. So, real property includes office buildings, plants, warehouses. Land is not depreciable. You don't take any depreciation on land. It is real property. These are the things that are considered real property. You get into some tough things like, what about items that are attached to a building and such, and it's a little more beyond the scope of our course in terms of the complexity of what constitutes real property versus personal property. Usually, though, real property is depreciated using the straight line method. So there's you recall that method from Accounting 101, and there's a couple of specified recovery periods. So the tax law tells you how long to depreciate. There is no judgment, if you will, as we discussed in Accounting 101, as to the length of time a real estate asset should be depreciated. All right, some examples of tangible personal property: furniture, fixtures, equipment, computers, all that kind of thing are tangible personal property. Usually are detached from the actual physical, real estate. They are based on MACRS, or double declining balance. That's the part that you are familiar with. But there's also bonus depreciation and Section 179 depreciation, all of which is designed to allow companies to depreciate more than you would normally do for financial reporting purposes. The idea being, if you can depreciate things quicker, you'll be more likely to buy more property from a tax standpoint. And so this is the incentive to get people to buy more and hopefully grow their business, and therefore hire more people and all of the other good things that go along with that. So to really accelerate depreciation, we have in 2018 bonus depreciation. Now, the concept of bonus depreciation is not new. We've had it around for several years. But for 2018, it is 100% of the personal property. So it doesn't apply to real estate. And it was 50% previous to September 27, 2017. And will go back away or start to drop in percentage in 2023 under current law. So that's kind of how they do, is push it out far enough. You do get to elect. You do not have to do this. You could decide that you do not want to to take the bonus depreciation or take partly the bonus depreciation or part of what is allowed. Example here, if we take full advantage of the bonus depreciation, we depreciate all $25,000 of this tangible personal property in 2018. If he decided to not take advantage of the full thing, just only took 50%, perhaps his income for this year is not as high as he would like, then you would use the MACRS to depreciate the rest. So you take off the $12,500 for bonus, and then you would do regular MACRS depreciation, which we'll talk about in a minute, for the remaining $12,500. That's how these bonuses or Section 179 scenarios work. You take first the bonus, and then the rest is depreciated using the regular rules. Now for 2018, bonus depreciation applies not just to new and used property, or used, however you want to think about it. So in the past, previous to September 27, 2017, used tangible personal property like Drew did would have been not eligible for bonus depreciation. But that rule changed with the new tax law, and now it, as long as it's purchased, you can't inherit it or receive it as a gift. Used property is now eligible, and so therefore Drew could deduct up to $50,000 of bonus depreciation on this personal property, all in 2018. So the part that you don't use the bonus depreciation for is calculated using the MACRS modified accelerated cost recovery system to calculate. And it simply takes the cost of the asset, basis of the asset, and multiplies it by a percentage provided in the IRS table. You just have to figure out which table to use. That's the key. And then what year we're talking about. We do not consider salvage value. You do not have anything like subtract salvage value out when you do this calculation. So I take the cost and multiply by the percentage. There is in the tax law a half-year convention, and basically what that means is that we assume that all assets are purchased on July 1st that are bought during the year. So you get 1/2 of the year in the first year you own it, and 1/2 of the year in the last year you own it. So it applies both in the year of purchase and the year of sale, and it just makes everybody's life easier because we just assume that it's 1/2 of the year is depreciation. All right, for that. Now, the IRS tables are set up to consider that, so you do not have to then take half of, once you calculate depreciation, using the tables, you do not have to calculate half unless you sell it early. Okay? Unless you sell it early, meaning that you don't, before the end of its useful life, as the tax law says useful life is. Okay? So, here is a table using the half-year convention. The true double declining balance percentage for year one would be 40%, but because it's half year already built in, it's 20%. So you multiply the cost by this 20%, you do not have to then take it again. The percentage. Notice that the 5 years actually takes 6 years, right? Because a half year here and a half year here. 7 year takes 8, half year and a half year. If you sell it in year 4, for instance, then you would calculate depreciation by multiplying by this percentage and taking a half, because this one has not been adjusted for the half-year convention. Just the last one and the first one. So things that included in the 5-year, 7-year, those are your 2 that you're going to use most often. Okay? So if we were 7-year property, placed in service clear back in 2014, we're still depreciating it, it was $10,000, we would take that $10,000, we would go down, go to the 7-year table, go down to the year 2018, the 5th year. So the first year would have been 2014, second year 2015, and so forth. We're in the 5th year, so we would multiply it by 0.0893 or 8.93% to get the depreciation for year 5. So there's how that would be calculated each year. So you have to, this just reminds us that we sell it before the end of the year, we have to multiply, do it in a half. Here's an example. Sold in 2018, that's before it reaches its end of its useful life down here. So in this year, we would then multiply it by the 19.2 and then divide by 2. Or multiply by a half, however you want to think about it. So that's... Now, there is a mid-quarter convention which assumes that we put our personal property in service midway through the quarter. Okay? It assumes that they dispose of it halfway through. So anytime January through March is assumed to have happened on February 15th. Now, that's not as nice and clear as doing everything in the middle of the year. So we don't really like this convention. It makes for a lot more work, and it identifies each asset in the quarter. But it is simpler than trying to figure out the depreciation based on exactly the day it was purchased or sold, for that matter. Okay, and then you have to worry the same thing when we can get rid of something at the end. We have to consider the depreciation for only part of the year. Now, notice that with the mid-quarter convention, you're always using 1.5, 3, 4.5, 7.5. It's never an even number because midway through the quarter is always the middle of the month. So the middle of the first quarter is February 15th. Okay, so, and here's just the way it would look for each of the numbers. The tables still help us. We just have to worry about it if we sell it before the end of the useful life. So, for instance, using the mid-quarter convention table, 5-year property in the first year, if it was put into service in the first quarter, you get 35%. Then 26 and 15, so forth. If it's second quarter, you use these percentages for each of those years. So you've got a little more complexity because of the mid-quarter convention. There's the third and fourth quarter. These are provided for you to use. When do we have to? We'd only use the mid-quarter convention if we had to, right? I mean, it's more work and everything. But the tax law says that if you put more than 40% of the total personal property, now real estate doesn't count, only personal property in the fourth quarter. So basically, you knew that you get a half-year depreciation on everything, so you buy everything at the very end of the year in order to get a whole half of the year, even though you didn't own it for very long. They say if you do that, if you put too much of your assets in the fourth quarter, you're going to have to use the mid-quarter convention rather than the half year. If you don't, then you can use the half year on all personal property. So here's an example, 5-year property on July 6th, 7-year on November 5th. this 60,000 is more than 40%, so the mid-quarter convention has to apply to both properties. That's the bummer. If you trigger this, it applies to all of your personal property for that year. And when you do that, it's going to be that way for the entire life of that asset. Once you're using the mid-quarter convention for that asset, you're stuck with it for the rest of its life. So you would be using this table, okay? Two properties, first on July 6th, the fourth quarter, and then we're going to use the 7-year property using this table. Same example, okay? So you use the quarter table based on when it was purchased, all right? So we'll pick up with some more options on depreciation in part 2.